Hi, everyone. This is Jason Barrack of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He runs the Macro Visor newsletter with Aisha Tariq, who's on business TV on Fox Business, CNBC, Bloomberg, almost every day, Monday through Friday. So Macro Visor and Trader Aid, Markets and Mayhem. Thank you for joining me again.
Jason, thanks for having me back. It's great to be here with you. How are you doing?
Doing pretty good. And as usual, the markets are just absolutely wacky right now with all the cross currents going on.
It's an amazing time. It feels a lot like 1998, 1999 in some ways, especially with some of the names that are running the hardest. Lots of short squeeze, low quality, unprofitable growth companies that are highly speculative, but also a lot of broadening in the leadership of the market. So it's kind of a mixed bag. You got all the stuff you don't want to see running, but you've also got broadening out of the narrow breadth, particularly today, some of the other less loved industries starting to run. So it's interesting from that perspective. And then you zoom out to the broader S&P 500 as the cash index is really driven by options flow. You're seeing a lot of roll up to the 6,300 strikes. That's a big wall of calls. And then also the 6,500 strikes. So you see some of those larger desks expressing confidence that this uptrend can continue as it broadens out.
And to add to Mayhem's points here, we have the S&P 500. It's almost at an all-time high, at, almost 6,300. It's just under that briefly. I think it was 14 basis points off the all-time high. The US dollar on the dollar index, it's off to, I think it's worst started in like 30 or 40 years. It's down over 10%. Maybe that devalued dollar is also fueling this stock market rally. But then you also have the problems in the bond market and the commodities markets are also wacky. But first, since you have a tech background, Mayhem, I want to ask you about all these big tech companies. We're seeing it in the headlines. So Microsoft, Salesforce, IBM, just insane amounts of mass firings. And these are not the low-paying jobs. These are really high-paying six-figure jobs. These were considered, good, long-term, stable jobs for a long period of time. Do you think that this is going to accelerate a recession in the private sector?
I think that at the very least, it's going to change where jobs are created and it's going to foster a fair amount of layoffs in areas where there's redundancies, where there's underperformance, where there's jobs that can be fully automated and or driven by these different artificial intelligence agentic applications. So I'd be cautious on saying it guarantees a recession, but I will say it definitely could slow the economy further. And I would be looking for the potential for economic growth to kind of trough out a bit, maybe in the mid 1% range as this comes out. And if it does turn into a situation where there's cascade effects, like you have folks being laid off in different industries, then we start to see, other signs of stress like higher default rates, higher foreclosures, things like that. That's where I'd be more concerned that, yeah, you'll probably see a bigger spike in unemployment and the Fed really have to ride to the rescue. But right now, I'm just not seeing it in the numbers. We had jobless claims come in today lower than expected. We have unemployment still near historical lows. And so the big tech firings that are happening at companies like Microsoft, Meta, Intel, IBM, Dropbox even, and then even in some of the big banks like JP Morgan Chase, a lot of that to me is sort of efficiency gains that can be driven by AI, automation, or some combination of the two that are set to continue. And as we were discussing a little bit off mic before the show, are also likely to spread throughout some of these other industries that could be bigger beneficiaries because, quite frankly, the early adopters here are these companies we're talking about. We've already seen a good chunk of displacement there. That doesn't mean it can't continue, but it does tell me in a lot of these other industries where they're going through their own digital transformation process, this could hit those harder. And there's a lot of different ways this is being driven. I mean, it's the conventional AI that we keep hearing about, these large language models that can generate text and image and video and music and other things. But it's also in other areas of AI, like Palantir's Foundry platform, helping companies harmonize records across different databases, get ahead of preventive maintenance, be able to identify trends and capitalize on them, improve their supply chains and everything like that. There's a lot of different areas where efficiency is going to ramp up, which is good for investors. It means you're going to see better margins and you're going to see improvements in how companies are able to run and get out of the way of trouble. But on the other side, like you said, there are real world impacts. But I would just say this one last thing. I think that with a lot of the other technical innovation trends, there's going to be job growth in other areas. For example, and it's obscene right now, and maybe it shows a little bit of desperation even, while Meta is cutting thousands of jobs, it's also offering 8-figure, even 9-figure sign on bonuses and sometimes ongoing compensation for high level AI experts to join their effort to get ahead of super intelligence. So there's a shift too. And there are areas where there's gainful employment available in tech, but it's a very specialized set of skills.
So it sounds like there's going to be beneficial deflation, increased productivity for some companies and some industries. So if you're a business owner, say in another industry, and you can reduce the amount of human employees, or let's say you work at a law firm and you could take a large language model, which is a larger artificial intelligence software, open source like a Llama program from Meta, and you can then hire a custom coder computer programmer company to make a smaller version for legal research, like a legal research database, and then you would reduce the amount of paralegals on staff you have. So I think we're going to start to see other companies and other industries start to take this beneficial deflation and create and institute what creative destruction. I think creative destruction is probably a good phrase for what we're going to see coming for businesses and other industries with this better and cheaper software.
I 100% agree. And I would say that the writing has been on the wall for some time. When we look at companies like JP Morgan Chase, who's a little bit more innovative in the banking space, they've been leaning into variations of AI for over a decade. And one of the stories that caught my attention was an AI completed 360,000 hours of finance work in just seconds for AI from AI. There's another, and this is actually from March 8th, 2017. There's another one where JP Morgan used a similar type of AI, a language model, to process a large volume of legal documents that would typically take over 10,000 hours in a matter of minutes. So you can see how a lot of what used to be very intense work for teams of people would take a very long time, cost a lot of money. A lot of that can be automated through AI. And that's going to lead to, like you said, some deflation in the realized costs that these companies have for their operations and capital investments, but also really a lot more efficiency. Because if you can take something that would take 360,000 hours and do it in seconds, imagine how that scales.
And it's good for the business owners. So for the investors, the business owners, let's say you're the $500 an hour billable or more trial lawyer or a partner at a law firm, that's good for you. You just reduced your overhead. You don't need as many paralegals on staff. You don't need as many gophers or lower level legal research associates that you just hired out of law school and passing the bar. You don't need as many of these employees to go through the books, because when I was in law school, people probably aren't aware, I was in law school a long, long time ago, and then I quit. They had a legal research class and you weren't allowed to use the databases, the legal research databases back then. They wanted you to waste all this time going through all the books and the casework. Well, now, like you said, they could just look it up in a matter of minutes. What used to take a human being potentially like many hours per day for weeks, if not months, to find all the cases, an artificial intelligence software can look up all the pertinent cases. Now, maybe there might be some cases it creates out of thin air, so they have to work on those bugs, but they'll find most of the cases and then even write a research report summarizing this stuff too.
Yeah, so one of the things that we've been looking at, and everything you said is absolutely spot on. And to address the last point, is retrieval augmented generation. So instead of AI being given sort of free roam to go through its inference data set, and if you think about how AI works in these LLMs or language learning models, they're generally large multiplication matrices of inferred relationships between data. So the AI doesn't necessarily understand fully what it's looking at. And so it can make false inferences. And that's where these hallucinations tend to come from. And there's different parameters to how you infer this data that can sometimes make it more likely. One of those that gets talked about sometimes is temperature. And this has nothing to do with how we think of temperature. In the world of AI, temperature is a setting that's sort of the computer equivalent of creativity. The higher the temperature setting, the more the AI might be a little bit more loosey-goosey with which variables it infers are related to others. So pulling that temperature down a bit can help when you're processing data. But the other part, as I was alluding to earlier, is retrieval augmented generation. And that addresses some of the concerns with hallucination, because what you're doing is you're giving the AI a document, a set of documents, a database, or a web retrieval mechanism, or something else that connects it directly to a set of data, whether dynamic or static, and it can query that data and get answers that are actually driven by whatever the data set is. So if the data set's high quality, like you're plugging into specific cases in LexisNexis's database, for example, and you're doing legal research, if your model is properly tuned, it's not really going to have hallucination risk. And so that's another bit of progress for data mining and analysis that's happening, is how the models are becoming more sophisticated in their ability to sort of stay grounded with what their task is and how they're supposed to relate to the data set they're analyzing.
Okay, so for legal research for something like a Bloomberg terminal, because I mean a Bloomberg terminal, that's one of the it's a moat for Bloomberg right now for 29,000 for a Bloomberg terminal to lease it. I mean the hardware and the software, it's old. It's a piece of crap. I mean, like honestly, there should be tons of innovation there where it should be better and cheaper. Hopefully artificial intelligence software. I know Perplexity is working on something, but they're working on so many different things, Mayhem,
Yes.
that maybe someone else in the space will start to innovate here. There should be a Bloomberg terminal that's better and cheaper with better software, better research, better hardware for way under $2,000 compared to what is sold in the financial industry.
I couldn't agree more. And in fact, I think that, having used Bloomberg terminals and worked with other folks that use them to query data in the past and present, I will say that it is such an outdated interface. And while they're working more with LLMs on the back end to summarize news and to provide other kinds of analysis, it's just the price versus value proposition outside of the breadth and depth of data access is not nearly as strong. I imagine there's going to be a lot of disruption in this space because as long and having looked at this myself, as long as you can find data providers for the vast majority of what they provide, and you can aggregate that data and provide it at a cheaper cost, the next most important part is the layer that you drive for interfacing with that data, whether it's analyzing it, visualizing it, sorting through it, searching it. And the way things are going, it's like you said, it's inevitable that we're going to see more competition in this space and in other spaces that are similar to it. Quite frankly, if you want to sort through a 10K and you have a good model that has some training in financial information analysis, and there are a number out there, commercial and open source, on places like Hugging Face, you can do retrieval augmented generation, feed that 10K in, tell it exactly the type of analysis you want it to do, make sure your settings are properly tuned so that it's not getting creative with this data on things like top K, top P, temperature, etc. And you can get decent analysis that like a junior analyst would give you, and you're spending a fraction of the time, a fraction of the money, and you're getting, analysis that you should obviously double check the work of, but can be extraordinarily helpful rather than having to sort through such a large volume of data, which can become over time just a little bit mentally taxing when you could be using your time better elsewhere.
And I think Perplexity, their pro version, is working on a version of what you just described. So it's going to take some of that data that used to be in Yahoo Finance, the pro version, or Bloomberg Terminal, and they're working on integrating the conference call data and the financials so you can integrate it with Microsoft Excel with a artificial intelligence software program and do cash flow modeling and just tell the prompt to make formulas for you based on the quarterly data and stuff like that, projections.
100%. A lot of that stuff is coming a long way. And the beauty of how everything is taking shape is if you're doing self-hosted or cloud-hosted AI and you have some, development skills, or you're willing to go out there and try the whole vibe coding thing that's going on right now, you have a whole bunch of existing Python libraries that can really help to add to your ability to look at this data set, whether you want to visualize it, back test it, whether you want to have other types of analysis. The Python open source community is also extraordinarily generous. So in terms of data analytics and financial, peripheral libraries and otherwise, and interfacing with different data providers via APIs, there's so much out there. So it behooves all of us, to always keep learning in finance. And there's such a massive intersection between technology and finance right now that I think it also behooves us to put that other leg in tech and see what we can do to accelerate our journey. Because a lot of the folks that are listening right now I'm imagining are retail. And that's awesome because never before have we had access to the breadth and depth of data that we do. It can be a little bit overwhelming. This is where automation and AI data analytics can give us a better edge in today's markets where there's so much data to look at.
Are you surprised that the big tech companies are starting to fire like salespeople? They're saying that they're going to automate that. I think you mentioned also that HR professionals are being automated. Are you surprised that kind of these people jobs that are relying on customer service and people relationship jobs are potentially looking at being disrupted and automated too?
So I will say I'm not as surprised as I am interested. And here's why I'm interested. When you look at HR as a field, and when you look at even sales and some of these other fields, a lot of it is already, before any of this started, had already seen automation and analytics playing a big role. For example, let's say you're looking for a job. And let's say it was 5 years ago before, AI really started to scale. When you sent your resume into HR, they have some kind of analytics looking at it that would sort of score the interest level and sort it so that when, they were overwhelmed with resumes, these were the ones they were going to consider hot and going to open first and try to query these folks. And we're talking about larger companies that have that technological scale to sort of automate what they can in the enterprise for efficiency. So what I'm really saying is there's always been this interest in making things like human resources or sales more efficient. Now, what we're seeing is full blown LLM analysis of resumes, which means your resume doesn't even get to an HR human unless an LLM approves it. That's sort of the new model. We've taken the gatekeeping by automation to the next level. And this means really you've taken a lot of people out of play. It also means when you're tracking the metrics, like when you're surveyed for your productivity metrics, which are often gathered automatically, like how many tasks you're doing, how much time you're spending on your computer, what are your aggregates of productivity? Those are also generally scored more and more often at these larger companies by AIs. And so that's another area where HR used to be poring over different metrics and telemetry data and otherwise and trying to infer who's doing well, who isn't. Well, you can automate that task too. So then what it really comes down to is HR's, core role starts to be managing all of this workflow and then also intervening in the more human to human conflicts and policy violations or legal concerns or otherwise. But that also means that in aggregate, you don't need as many humans. And the same thing is true in sales. And the same thing is true in a lot of the other work. Like, I know initially people were saying, oh, this is really going to kill software developers. And you've seen a lot of the layoffs there. And that's true. And it's also going to have an impact on some of these other jobs where AI is going to be more efficient, like paralegals. You're already seeing that becoming a bigger trend in accounting analysis and consulting. AI is also taking a bigger role. So I'd say that over time, if your job isn't one where your creativity or ingenuity or intelligence is something that can be easily replaced with the current tech and some of the stuff, the direction it's trending, you probably got some job security. Or if you're senior management, you probably have some job security. But in other areas of white collar work, and as robotics become more sophisticated in automation and blue collar work, those jobs are going to become more replaceable over time. It's not all bad news, but it does mean we're kind of at this inflection point socioeconomically. And I like to call it the duality of either Star Wars or Star Trek. We're eventually going to have so much excess productivity that we could have a world where no one needs to be hungry, where no one needs to live without a home or without medicine, or we can live in a world where everything is very mercantile, it's very us versus them, and it's largely AI and robots and things like that that are pulling wealth and power even further upward to a K-shaped distribution that the bottom tiers of society are very oppressed by. And so that inflection point is right ahead of us. And it's really going to be about collective humanity, and particularly those people in power, as to which direction we take on that fork.
I think Tom Bilyeu, who's been covering this, he's been interviewing a lot of science fiction authors and writers, asking them about this based on like stuff like Blade Runner and Terminator, some of these other science fiction movies and TV shows, because they've been predicting some of this stuff for decades. What type of society, if it's going to be, a utopia or a dystopia or some weird type of mix. It's unpredictable at this point because of the amount of creative destruction. I don't know if we've ever had this much potential disruption in this shorter amount of time with the innovation, because what the artificial intelligence software, the computing power, isn't improving like it's almost doubling every 6 months or something like that. And the humanoid robots, they're improving at a very, very rapid pace too.
Yeah, it's even more remarkable than that. So remember DeepSeek in January, everyone was freaking out. They came out with the 641 billion parameter R1 model. And it was next generation because here's a model that is largely open source. They pretty much documented everything they did from the training data to how they built it to how they infer. They made a lot of innovations for the inference workload, the way the stack works. And say what you will about what's happening in China about the way they're innovating in AI. Quite frankly, I think it's all very impressive, but they've come a long way. That was at the time considered extraordinarily disruptive. Fast forward to maybe about 4 months later, and we saw Alibaba drop Qwen 3. Recently, we've seen models coming out from Tencent and from Huawei and others. And these models in general are smaller and just as, if not more efficient than DeepSeek with its 641 billion parameter model. I mentioned Alibaba's Qwen 3. That one is a 32 billion parameter model. So you can reasonably say if that model can keep pace or in some benchmarks exceed DeepSeek R1, then in just over 4 months, we had a 20-fold increase in efficiency or a 95% reduction in the resources necessary to get the same quality or similar quality of inference. So we are in an AI efficiency arms race. And that is the theme, I think, that is going to become more and more top of mind to a lot of decision makers, whether they're looking at adopting AI because it's becoming far more tempting now as costs go down, or whether they're looking at becoming a startup that tries to build one of these AI applications that they monetize over time. Because again, the cost of access has come down appreciably. But also, as we innovate, there's still so much more improvement that is coming down the pipeline. I mean, the things that I'm seeing just in the self-hosted world, and I'm very active with self-hosting AI models because I find it intriguing just how much even a decent workstation computer can do if you have enough video memory. The efficiency gains there in the last 6 months have been extraordinary. And obviously, you can self-host DeepSeek R1 if you have a huge amount of video memory. Most people's computers are not capable of doing that. But if you have even a decent video card, you can self-host Qwen 3 with a decent token generation rate, meaning it's fast enough to interact with. So we've seen what used to be reserved for cloud level AI now starting to creep into workstation self-hosted inference at reasonable costs. That's all game changing. We're also seeing more and more work to either allow other stacks to have similar capabilities as NVIDIA's CUDA, like AMD's ROCm or OpenCL or otherwise. There's progress being made there. But Zluda is also making headlines again. And I talked about this one last year that, we're eventually going to see these sort of compatibility layers that allow CUDA code to run on different hardware. And suffice it to say, if a company like NVIDIA has a 75% margin on their GPUs, if you're able to get that same or similar compute elsewhere in an appreciably lower cost, you're going to be inclined to do that. And that is, again, deflationary. It's good for the entire AI ecosystem, maybe other than the pick seller, the pick and shovel seller, NVIDIA. So you can see eventually, and I'm not saying NVIDIA is headed to disaster or anything like that, so don't get me wrong, but eventually, you could see companies like AMD, Intel, Broadcom, and others that are making these AI accelerating chips become more formidable parts of the inference stack. And indeed, you already see companies like OpenAI using more and more of AMD's MI series AI chips or their data center GPUs in their own inference, which are far cheaper and still deliver really strong performance. You just have to have a different software layer to do your training and inference.
So you don't think then that Taiwan Semiconductor has an enormous moat because they're one of the only two companies, what with Samsung being, I think, the other one that can do the 2 or 3 nanometer, the semiconductors right now with the silicon?
Oh, I absolutely think that Taiwan Semi enjoys a formidable moat, and their 2 nanometer scale process is superior to Samsung based on what I've seen. Samsung is really not able to compete. They still have more quantum tunneling issues there. I think that Taiwan Semi, and then eventually, once we start seeing Intel's foundries progress, Intel may be able to build a moat in this space. Obviously, this is a company that's been challenged for a long time, but they're under new management. And they have already talked about letting customers access their next generation foundries as they come online. So I would keep an eye on that one as well.
If they're not bought, I mean, the rumors are that there's like Broadcom, Qualcomm, couple of Texas Instruments, couple other companies already looking at potentially buying Intel in the next 12 months or so.
I would not be surprised at all. I think that's a great call on your part. And looking at the news and the kind of circulating M&A potential there, and it makes sense. Until, quite frankly, the sum of its parts is cheap enough that even if you just wanted to buy a few chunks and then spin off the rest, could make sense for any of the names you talked about.
Yeah, well, Intel hasn't gotten to the anywhere close to the 2 or 3 nanometer level because it looks like they were leading what in 2017, and they've fallen off the pack, off the leadership pace over the last like 7 or 8 years. But I think what the Nvidia CEO has talked about, they're planning on transitioning what to graphene light based chips in the next 5 to 7 years. Like there's like crazy innovations coming.
Yeah, absolutely. You're going to see light as the default path for moving data around. And if you think about what fiber optic does, that's kind of where all of the networking has really pivoted from copper to fiber. Well, we've got to do that on the motherboard level too. We've got to use photonic transfer of data to reduce delays and to maximize the bandwidth or the pipeline to move data around the bus, because we're now getting to the point where copper at a molecular level is becoming a bottleneck.
And silicon too. Silicon's not the best mover of electricity. Graphene, now that it looks like they finally, over the last 10 or 15 years, figured out a better manufacturing process because there was impurities, I think, in it. So they were still experimenting in the lab because remember, it won an award, right, for a Nobel Prize back in 2009, something like that. So it took many, many years of trial and error in the labs to figure it out, the manufacturing process to remove the impurities.
Yeah, nanoscale graphene is going to be a big deal in the future. Also for things like industrial scale reverse osmosis for ocean water to make it drinkable. There's going to be a lot of stuff that comes out of graphene in that sort of nanotech space.
Now, I want to ask you about killer app software for artificial intelligence software. The main one, the one that looks the best to me, is Google VEO3, the video software. I mean, it's in 4K, 8K. It's beautiful. What used to take like a Hollywood CGI shop, they'd outsource for a Marvel superhero movie. I mean, they'd have to take years, potentially, tons of editing. You'd have to hire all these different CGI houses. Now with the Google VEO3, it looks like they can almost do super high quality, like 8K editing and rendering for TV commercial, anime, video games. They can do it in a fraction of the price and a fraction of the time now.
It's incredible what Google is doing in the world of AI. And it's one reason that I have to still be bullish on the stock. In fact, this was one of our swing trades at TraderAid we've been talking about. It's one of the investments in my forever portfolio that I still remain upbeat on, even with some of the regulatory risk. And the reason that I like what Google's doing in the AI space is AI has always been in Google's DNA. Now, their current CEO Sundar, I'm not the biggest fan. I think that Google really needs a technological visionary at the helm. But even then, it's so much in Google's DNA that they were a little slow to get there. Remember, there were a lot of embarrassing releases from AI, the Google AI stuff that came out that was just either fake, or it had all kinds of weird content, or it just didn't work very well, or it gave false information. They've come over the hump and then some. Now they're all over the leaderboards for text generation, image generation, video generation, and VO3 is incredible. And it's almost, if you think about it, if you have YouTube and the entirety of YouTube is hosted in your cloud, and you can take all of that data and you can use that as the basis for training your video model, how can't you have one of the most formidable AI models for video generation? Because they certainly have the talent in their workforce to build this stuff. And they also have, and I would argue, probably the world's biggest database of videos to draw from to train this model. So it makes a lot of sense where VO3 is. And this is one of those things we were talking about. Where's there going to be some room for some potential creative disruption, as you said? Well, video creation and everything that is involved with that is a huge area of opportunity. There's a lot of VO3 stuff that comes out where it's hard to determine whether it was AI generated, that it's so realistic that it looks very, very much like something that could be sold as a commercial or as a short or even as like a TV program. And you're starting to see people in the creative industry moving towards it. I saw one post on Reddit where someone was talking about what used to cost $200,000 to create a 5-minute spot high-end commercial. Now they can do in VO3 for like $600, $700, $800. It's disruptive, but overall, The name of the game is deflationary efficiency gains. And so if you think about the other side of that, what does that do for the average small business owner who couldn't afford any of this before? Well, now they can create a Hollywood grade video promotion if they want to, right? They can have something that they never have access to before at their fingertips. And so on the one side, yes, there's going to be folks that don't get the same pay or maybe see their jobs lost, and that is unfortunate. But on the other side, there are beneficiaries here, and it could be really quite revolutionary.
Yeah, for TV commercials. So if you're a small business and you don't think that you could have hired like a Hollywood CGI shop or Hollywood producer or director to make a TV commercial for you, you can almost do it yourself with a script on a budget for a fraction of the price, and you can do it in like basically 8K right now for a fraction of the price with the new video software. And the other thing about Google VO3, I think the price is already starting to fall because I think it was $250 a month, and I think it's below $200 a month. There's all this competition too. So there's like Chinese startups, American startups, they're all pushing each other, and this overall, it's long term, it's benefiting the economy and it's benefiting other small businesses and other consumers in other industries because they're going to have access to the software and the technology at a lot cheaper price that they never would have been able to in the past.
100%. And it's going to be disruptive in other areas too, because there's a lot of overlap with the video game industry, for example. And it costs a ton of money to produce a AAA game. So if you can take some of that graphical artwork and environment generation and some of the other content that needs to be created for the storyline and otherwise, and you can fast track, accelerate the progress and reduce your budget by using AI. And it's already happening. It's very disruptive. I know folks in that space and they're saying this is a game changer. It's great for their margins. But again, there are areas where careers are going to have to shift. But if you think about it on the other side of it, if you were like a small, scrappy indie studio, your capabilities just 5 or 10 folded. So that's a really good sign for founders and startups and even the smaller companies. It's not just the big boys that are going to benefit from this stuff, because a lot of these AI products are sort of AI content generation as a service, and you're there paying as you go. That means it's accessible for everyone. And like you said, VO3 costs are coming down. There's lots of competition. Competition fosters innovation all over the space, and the rate of innovation here is breathtaking.
Now, I want to transition to macro questions. I want to ask you about the yields on US Treasuries, the dollar being weak. Are you surprised that the stock market is doing so well given all the macro cross currents with the weak dollar and US Treasury bond yields on the 10-year, the 20-year, the 30-year US Treasury?
It's a great question. So, on the one hand, I think that we have fattened tails in both directions. And that just means we really do have both more upside and downside risks. It's a thinner, less liquid market. There is some degree of capital that is leaving. That's one of the reasons the dollar is weakening. There's a bit of a loss of confidence from how the current administration has addressed our trade partners and otherwise, which is why the dollar had the worst start to the year since 1973. I think a lot of it has to do with that. But on the other side of it, when the dollar goes lower, 40% of the S&P's ability to make money can improve, right? And actually, they start to see larger inflows from overseas for that capital. That's part of what I think is somewhat helpful here. The other side of it is that we still have the most attractive financial assets on earth, which is, even though, Europe and parts of Asia were outperforming US markets, now we're starting to really more than catch up here to a lot of these markets. Not all of them. Places like Greece are, up about 50% year to date. But suffice it to say, I think that we still have a lot of fiscal driven expansion of demand. And this has been the theme since summer of 2022. It's one reason we didn't get anything more than sort of a mild 2-quarter recession, because back then, to the criticism of many folks, and including folks like us, because we don't really believe that fiscal expansion at the cost of huge deficit spend and risky levels of debt is a good thing, but you can always kick the can. You can always fight a recession by doing things on the monetary and or fiscal side to offset slowing growth. And so that's exactly what happened in 2022. Powell was raising rates aggressively, and the Biden administration saw the potential for a recession that could get quite a bit worse. And they said, the way that we're going to do this, because we're also getting up on midterms and we really don't want to have a recession ahead of this big vote, is we're going to try to get into some fiscal dominance here. We're going to overpower the Fed by signing not just one, but 2 extraordinarily large bills into law that drive government demand, but also drive that sort of asset froth, right? You have more liquidity coming into bank reserves. That liquidity looks for stronger returns. It often is from folks that are, it gets transferred up to higher spectrums of folks, the top 10%, the top 1%, et cetera. They want to invest that money. They come into US financial assets because it's the best market in the world. And so we're seeing that repeating all over again. The Trump administration, Besson has really said, we want to spend money to grow the economy at a faster rate than where the deficit is growing, and try to kind of get ahead of this. So their idea at first was, oh, we're going to have the country take its medicine. We're going to maybe induce a recession. We're going to try to bring rates down, get the debt cheaper. They threw that whole playbook out. Now it's the opposite. Now they're like, well, let's see if we can just sort of run faster than the rate at which our debt is growing to grow the economy and to try to get ourselves out of this mess. And so that's, whatever we think about everything else going on, if the fundamental catalyst for an appreciating bid in assets is an excess of liquidity seeking returns, we still have that as a backdrop. And that probably explains some of the action that we're seeing in the S&P 500, where you see roll-ups to 6,300, in the short-term options, the week and less, and roll-ups to the 6,500 strike on some of the longer-dated calls. It's an expression of confidence in higher highs, as well as some of these bigger banks talking about revising their price targets higher for the S&P. So do we have a fat and tail on the left side as well? Yeah, absolutely we do. It would be remiss to be just blindly bullish and say, boy, the only thing the market can do is go higher. I do think when you make all-time highs, you're going to probably make more all-time highs. That's typically how these big multi-time frame breakouts work, and all-time highs are the biggest time frame breakout you can have. But on the other side of it, we do have to be cognizant that there are some risks that are building. We are a bit overbought on the New York Stock Exchange. We're getting closer to overbought on the NASDAQ. We do have Q2 earnings season coming up. Now, it's probably another, kind of low-hanging slam dunk, because a lot of these revisions are coming in again. They play this game a lot. And the idea is, when the estimates come down for these revised estimates, you have companies that are more able to beat what the street consensus is and get a positive reaction to their earnings. So you're seeing a lot of that ahead of earnings, kind of sets us up for a backdrop where we could have some continuation. But we're also coming into some more difficult seasonality. So July is a great month for stocks. June is a great month for stocks. July, 90% of the time over the last decade, S&P's up like 2+%. But as you get into August, September, October, those tend to be more turbulent months. Seasonality of volatility tends to be stronger. So, you tend to have a choppier market. You tend to have more downside risks. And often if there are those risks realized, you get a bottom in October. That tends to be that seasonality into more favorable November, December, and January seasonality. So I'd say there are a number of risks forming. Macro, as you mentioned, the rates are something I'm watching. I personally look for the 10-year above 4.5% with continuation and velocity in that move. Grinding higher to there is not a really big concern to me. But if you see a move that's really fast and you start to just push way above 4.5% and you continue moving higher, that concerns me, because that is liquidity negative. If, again, we're contextualizing a lot of the reasons that markets move higher is in no small part because of an excess of liquidity, when that turns the other way, you've got to look out, because about $100 trillion of global debt is priced in 10-year rates. And a lot of that debt is dollar denominated. So the worst case scenario would be you get over 4.5% on the 10-year with velocity continuing higher, and the dollar starts to rip higher too, because then you have that double barrel shotgun staring down that debt, making it appreciably more expensive to maintain. And that starts to dry up global liquidity a bit. And people might say, well, but the Fed can come in. Surely they can fix this. The Fed's policy framework is very short end oriented. They don't affect the long end as much as you would think. And often is the case, the yield curve moves in ways that don't necessarily cooperate with Fed policy. And the simple explanation there is the bond market's a lot bigger than the Fed.
Well, I also think that Jerome Powell and the Federal Reserve Bank, the voting board of governors, I don't think they're going to help Trump. I think basically a lot of his comments, you have the 75 basis point rate cuts a couple months before the November elections, which I don't think were justified. They did point to certain cherry pick data saying they were justified. I don't think they were justified. So I don't think he's going to help Trump with the rate cuts, even though Trump is writing all these notes, trying to embarrass him publicly. Do you think that President Trump and Scott Bessent, do they want a weaker dollar? So basically then that's one of the things they wanted is a weaker dollar similar to what we're getting now?
Yeah, a lot of things there that you said that are very interesting to talk about. We'll start with the weaker dollar. I think they do. I think they talked about that prior to even Trump being elected, that they wanted to make America an export powerhouse, that this trade war was a part of it, but the other part of it was weakening the dollar to make our exports more attractive. I think the trade war has been a bit deleterious to global confidence in the United States, which is another thing that's helping to weaken the dollar. I don't know if that's the policy outcome that they wanted for that reason, but it's certainly one way that that's being driven. Now, I think that with the Fed, Powell can't be Trump's friend, even if he wanted to. And I agree in the sense that I don't think he's really inclined to be. And Trump has been very antagonistic of Powell in his first term and in his second term here. So I could see some reasons why he might be a little obstinate. But when you keep talking about policies and then going back and forth like a pendulum with policies that could induce some short term price gains, like tariffs, that doesn't give the Fed the level of clarity they want to see to be able to act with any degree of confidence. And so, if they were starting to get acquiesced to the idea of, okay, we've got some trade deals, they're not going to hike tariffs too much, and we're not going to see too much more than what we've already seen. That all changed over the last couple of weeks because now we've got a whole new round of tariffs, even with major trading partners like Japan and South Korea. There's now the idea of this 50% tariff on copper, which is supposed to kick in on August 1st. There's tariffs as high as 50% on Brazil. This stuff is not really well thought out. With copper, for example, it could take decades to get the kind of mining we need to meet our demand. I think we smelled about 1 million ounces or 1 million tons of copper here, and we have about 2 million tons in total that we use. So it doesn't necessarily, the math doesn't add up. Even if we start to bring some of these idled mines online, it's not going to make up for what we need. And to bring the capacity we would need online based on ING's analysis, it could take 15 or 20 years, maybe as little as 10 years with accelerated permitting. But at the end of the day, Trump's not going to be in power that long. These tariffs aren't going to be impacting copper prices that long either. So it's just a lot of this stuff doesn't give the Fed the clarity that they would otherwise need. I know they look at backward looking data. I know they make their own projections, but one thing they keep coming back to is this sort of policy is too unpredictable. And I would be inclined to agree. And I think this is one reason that often is the case. Tariffs are something that is legislated, and it usually is through months and months and months of trade negotiations that then ultimately fail, that result in tariffs. So it's sort of like, okay, we're going to use the stick when the carrot didn't work.
Well,
This is the
he's
opposite.
yeah, he's doing it the opposite. That's what I was going to say. I think so. He came out and said 50% tariffs on Brazil goods to get them to the negotiating table. So then, instead of them retaliating, they'll sit down and they'll quickly start negotiating. I think that's his goal here.
Yeah, it's certainly the goal, but we were promised, I think, and there aren't even this many countries we trade with, but 200 or so countries that we're going to have trade deals. And then we're hearing headlines that, no, you know what, making these deals takes a lot more work than we thought. So maybe we'll get 18 trade deals done. And the problem that I have is, if you're going to have a trade war, you don't really want to start it with a war. You want to start it at the negotiating table. And if you can't get anywhere, then you start to use tariffs as the stick. Going the other way around, and the way that it's been done by, kind of going a little far on executive privilege, if you ask me, I just feel like a lot of this tells the countries and the companies involved this doesn't have staying power. Not only because he constantly kind of walks stuff back and vacillates, but also because it's driven by executive decree, which means as soon as he isn't in power, it's potentially going to be gone like a puff of smoke, versus a bill which would have more staying power. It'd have to be repealed or otherwise augmented. So if you're a decision maker and you're looking at a roadmap of 5 or 10 years worth of investment to get whatever it is these tariffs are changing the prices of, you're going to say, yeah, but in like 3 years, this isn't a concern. So am I really going to do anything other than give them a nominal headline that I'm not going to stick by?
Well,
I just don't see it.
Well, Mayhem, I'll just say for the record that if the US Treasury is bringing an enormous amount of tax receipts from tariffs, I don't think they're going to voluntarily forfeit the tax receipts, because look at Trump's first term. I mean, they made a lot on tariffs with China, many billions of dollars, and they didn't cut the tariffs under Biden. So, I mean, that if the government has tens of billions of dollars extra per year coming in tax receipts, I don't see them voluntarily wanting to sacrifice to take those tax receipts down to zero.
Well, I think that's a fair point, but I would also say that under Trump's first term, the tariffs were very benign compared to what they are now. And I don't think that if we look at tariffs contextually as a tax on trade and in some degree a tax on the supply chain and consumption, and this economy is 2/3 its GDP driven by consumption, when we see the next tough spot and the government's looking for relief valves to stimulate the economy, one of those is going to surely be through trade. And what you have happen during a recession is tax receipts crash. And so the government does whatever kind of stimulus it can do to increase the economy, largely through deficit spending, in part because tax receipts are down, but on the other part, because they're spending more money to try to stimulate the economy. So I think the next playbook is going to be, well, we're in a tough spot. Let's start to look at whatever relief valves we can use to induce some demand. And part of that's going to be the Fed and its response mechanism. But part of it can also be things like cutting taxes. And if we're honest, tariffs are another form of tax, and you can certainly cut them as well.
Well, they can cut taxes on certain entities, so small business, maybe certain consumer making a certain income, but we're at a point now where we just have a math problem and none of the options are really good. Look at the interest payments on the debt. The bond yields aren't coming back down. I'm sure President Trump and Scott Bessent want the bond yields on the treasuries to come down so they can refinance the debt. They don't want to be paying over $1 trillion per year in interest payments on the rapidly growing national debt. The big beautiful bill that was just passed was way more in spending than a lot of people were expecting. So, I mean, basically, we're at the point now where I think we're out of good options to delay pain for the can kicking, and there aren't good options.
Well, I would say that, on the one hand, if they wanted lower rates and a lower debt burden, then making an egregiously large spending bill that blows up the DoD budget over $1 trillion as well is probably not going to be the path to get there. And then in arbitrarily going through and kind of creating all these tariffs, like the price of copper is hitting all-time highs in the US. The divergence between the price of copper here and in the LME is the highest it's ever been. And copper is a huge part of this whole Capex spend for data centers, for scaling out power and otherwise internet connectivity for some of the more rural areas. Wherever you look at it, copper is such a key part of the economy that yields can't hope to come down when the price of copper is appreciating as much as it is and the pass-through impacts that can have. And then you scale that with every other thing that's happening that can similarly increase prices. A big spending bill means there's going to be more capital and bank reserves, which is going to be deployed into the real economy and the asset-driven components of the market. So it's kind of like they have pivoted from we're going to cool things down, we're going to pull down rates, and we're going to worry about the interest spend to we're going to run it hot. We're going to spend more money than we've really ever spent. We're going to make the biggest increase in the debt ceiling that's ever happened. And we're going to just keep doing it like that because this is the biggest can kick that we can possibly come up with since COVID to keep this economy from folding in on itself. So I think that everyone's kind of been aware the math is real bad. And in fact, the math has been bad for a long time. This is one reason why, policymakers couldn't afford to let the great financial crisis really be the reset that economically and socially it probably needed to be. And we've just kind of run things hot for a very long time. And this is what happened in the reaction to COVID as well, and why the Fed kept saying transitory, 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 because COVID was one of those moments where everything could have become unglued. We could have had a depression that with deflation that took root. And one of the reasons we didn't have that is they flooded the world with money and easy money, low interest rate policy to do everything possible to get away from that outcome. So anything that resembles a normal economic cycle has been replaced by an abnormal credit cycle. And the only choice that policymakers have, because we run on this 2-year political cycle, is to just kick the can as hard as they can. They know there's no choice, which is why things are getting sillier and sillier and sillier. And from one clown show administration to another, because you know me, I think all these guys are not great for our country, Democrats or Republicans. It's a uniparty. It's run by the richest of the rich. It's all about economic elites transferring power and money upwards. And it's also about can kicking because they don't want deflation. Because who does deflation hit the hardest? People who own assets, the rich.
And the government too. Yeah, the government, because then the government has to cut back. Yeah, because the world's largest debtor is the U.S. federal government, right? So,
yeah, and it's so there really are we're at a point. I think Lynn Alden has said this. Nothing stops this train. I mean, I have to agree with that mindset that they've decided long ago that no matter what, we just stick save, we kick the can, we put in whatever policy, and if we have to run it hot, we're going to run it hot. But we're not going to let the other alternative happen, which is the reset that, is pricing. The lack of that reset, I should say, is pricing out younger generations from buying a home, from starting a family, from being able to have any confidence in the economy. It's eroding our demographics. It's causing a lot more, of the population to shift to the older side. And, obviously there's some part of that that has to do with the country going from being more rural to more urban, where children on the familial ledger go from being assets to liabilities, because obviously in a rural area they're like farmhands, or they could work in the family business in some way. And in urban areas, and even in suburban areas that are a bit more built up, you're less incentivized to have kids, because now you have childcare costs and putting them through school and all these other things. And I don't mean to say that without heart. It's just the fact of the matter. This is the financial calculus that parents have to do when they consider, am I going to have another kid or even have a kid at all? And so if you add the fact that generations have been completely priced out of home ownership, or really anything vaguely resembling financial independence, that all goes out the window. So this short-term thinking, it's going to hurt us in all sorts of different ways. There's no denying it. But on the other side, what are we to do when the people that are in charge simply won't let anything resembling a reset happen, because they're more concerned about that upward transfer of wealth and power, where 14 of the richest Americans are worth just as much as the bottom 50% combined, or about 165 million people?
You have record wealth disparity. A lot of it's the Cantillon effect. My personal view is that post 2008, the entire system collapsed with the banks and the hedge funds, and the US federal government, basically with a lot of the policies, zero interest rate policy, quantitative easing, debt monetization, the hidden covert bailouts to the European Central Bank with the currency swaps, it went to full Ponzi scheme. Post 2008, there's been trillions of dollars created. I think I was listening to an interview with Kyle Bass last week, and he was saying in a 3-year period, I think from 2020 to 2023, he said the U.S. money supply grew by about 50%. And he said emerging markets, he said, if that sounds bad, he said he thinks that emerging markets grew their money supply, inflation, or currency debasement even more than that.
Yeah.
So there's just insane amounts of fiat currency just sloshing around. Well, people aren't going to hold it in a bank account. It's going to end up somewhere. Looks like it's ended up in the S&P 500 and in gold and Bitcoin.
And it's interesting when we look at it, because since the great financial crisis, the largest creator of global money supply has been China. So you're talking about emerging markets. For some reason, they're still lumped into EMs. I consider them a developed market, but that doesn't matter. At the end of the day, money supply creation from China has been a big driver of appreciating asset prices, and it's money that doesn't stay in the country, obviously, even if there are capital controls. But then when we zoom out more, this sort of spend and pretend, kick the can game, I would even say it's been going on for many, many decades. I think Greenspan was a big proponent of this. And Bill Fleckenstein wrote a great book about Greenspan's bubbles, where he talks in detail about how all the Fed really does is vacillate between creating and destroying bubbles, and really honestly transferring more and more wealth and power upwards. And, the Fed is a private entity. The only part of the Fed that's hybrid with its private entity in the US government is the Board of Governors. The regional banks are completely private banks. The way that a lot of the Fed policy is effectuated and decided is from governors that have closer relationships to the banking system and economic elites than Americans or the American government. And so at the end of the day, the Federal Reserve itself, which is now 112 years old, it has done a phenomenal job of transferring wealth and power upwards at the cost of our purchasing power, but also in the cost of that K-shaped distribution of socioeconomic outcomes. And this is a problem. Maybe we need something that resembles it, but it probably shouldn't be run by the same folks that are able to decide policy in a way that disproportionately benefits them and hurts a lot of other people, specifically and most particularly with this most recent episode of inflation that's really eroded the quality of life for a lot of American families.
Yeah, and a $2.5 billion renovation at the Federal Reserve Bank, the Eccles building here in Washington, D.C. What they're putting in, all marble, fancy restaurants that are subsidized by the taxpayer, a bunch of other ridiculous stuff.
It's weird. The Fed is got this sort of Ouroboros structure. So their balance sheet is composed of US Treasury debt. The yield on that US Treasury debt is then used to fund all of their ongoing operations, and including this renovation. And then whatever is left at the end of the year is paid back to the Treasury. So for the Treasury, when the Fed was doing QE, it was like having an interest-free credit card with a delay. Sometime they would get that interest back sans the expenses at the Fed. So this is actually paid for by Treasury yields, right? And it has everything to do with the Fed kind of morphing into being that buyer of first resort at a lot of the Treasury auctions that balloon their balance sheet to as large as it was. And I think that's another part. Now, people like to look at the Fed saying they're losing money. If we're looking at unrealized losses on their balance sheet, sure, but these things are all going to be held to maturity.
They're not marking to market the older bond losses either. I mean,
They
a lot of
can't.
the large banks like Bank of America, I think Bank of America is not really doing that either, and they have
No.
estimates of over $100 billion in losses too.
Yeah, and really at the end of the day, if we're being honest, nothing's going to let these things be sold at those losses to be realized. There's going to be all kinds of foaming of the runway to prevent exactly that because it would be catastrophic to the US Treasury market, to the financial system as a whole. It would kind of blow a hole in it. And so that's another thing that kind of tells you eventually at a certain interest rate or a certain level of velocity, there is some degree of accommodation to be expected to prevent that spiral outcome. Now, at some point, things will break. That's kind of like you're building a more and more complex house of cards that just needs a really strong gust of wind
Well,
to
the
shake it.
dollar. What will
Right.
break is the dollar's purchasing power, right? Because we don't know where all the currency is going with the bailouts. I mean, you mentioned the Federal Reserve Bank. They were paying what, $80 billion in profit remittances back to Treasury per year. That was for the quantitative easing program. So the balance sheet expansion. So they're taking this newly created currency, expanding the balance sheet, buying U.S. Treasuries, buying mortgage-backed securities, and the U.S. Treasury was making an extra $80 billion per year, what in dividends, basically. But that's gone away, I think, in the last like year or two when the Fed started raising a couple of years when the Fed's raised interest rates.
Yeah, so they've seen that portfolio shrink in value, but still has the yield. And I think that at the end of the day, the Fed is going to have to come back in and do QE in the future. When there's another crisis and things start to kind of come unglued, there's really going to be no choice but to bring down the cost of capital to induce demand to try to get things back up and going again. And the question will really be, is there enough slack that this could be even bigger in terms of the amount of aggregate stimulus needed than what we've seen in prior occasions. Because it seems like with every crisis, the Fed has to cut rates more aggressively. They've got to now, ever since the great financial crisis, do more and more QE. And I think that that is a trend that is likely to continue. And not just here, but in other developed countries with high amounts of leverage in their shadow banking systems and their public debt and otherwise, you just have a recipe for central banks kind of having to be that Ouroboros structure, sort of eating themselves and the government's debt and otherwise. And if you look into where the future could look like for some of these countries with declining demographics like China, the US, the components of the European Union, it could look more and more like Japanification if we can't start to improve that. Maybe AI and automation and robotics help us to get ahead of that. But Japan, I want to say they have a 250% debt to GDP ratio. The government of Japan owns more than half of the Japanese central bank, and the Japanese central bank owns more than half of the Japanese government's debt. It's a very strange structure, but it's not completely impossible that we could see things that resemble that in other countries as a matter of last resort if we're not able to grow ourselves out of it, which is, again, the Trump of the hope, I should say, of the Trump administration here is to try to grow ourselves out of it. Now, we know the math doesn't add up for that. It takes so much more debt issuance to grow the economy than it used to. I think it's $7 or $8 of debt issuance for every $1 of GDP growth attributed to that spending. But at the end of the day, there just aren't any good choices.
And Japan has a yield spike in their bond market, which is really starting to hurt them with all that debt because of the higher interest payments on the rapidly growing debt. They're basically in the kind of end game scenario for the total amount of debt in their bond market where they don't have good options left. But if I look at all these governments, especially the G7, if I'm a non G7 central bank, Mayhem, I'm thinking I don't like the policies from both political parties in DC. Trump is talking about tax cuts, but then why did all this government spending increase? We don't like their foreign policy here. And I think that's why you're starting to see a lot of these non G7 central banks, instead of accumulating U.S. Treasuries with their trade surpluses, and there is a relatively high yield that they could be if they wanted to, but they're not. And instead, they're accumulating each month their dollar cost averaging gold tonnage. And this has been kind of the macro trade for the last couple of years.
Yeah, and gold is somewhere that you go when there's uncertainty about if you're an investor. It's somewhere where central banks are going because they've lost confidence in the dollar. And they've lost confidence in the dollar for a lot of reasons. One of which is look at where this real gold bull market started and where the central bank gold buying spree started. It was early 2022. And Russia invaded Ukraine, and the United States and Europe said, we're just going to weaponize our Western financial system, especially the dollar and SWIFT and otherwise, to try to hurt Russia as much as we can. And other countries around the world took notice because they said, oh man, I mean, the dollar, the U.S. has done this with the dollar before and SWIFT and otherwise to countries like Iran and, Libya and otherwise, but, it's never been weaponized to this extent. And it's something that concerns us because we could be next. If we do something that really, irks the U.S. government, maybe they're going to cut us out of the dollar and SWIFT, and they're going to seize all of our assets, and our treasury paper won't be redeemable, et cetera, et cetera. It's not a far-fetched conclusion, not by any stretch of the imagination. And so that causes this slow and steady, up until recently, now it's starting to intensify a bit, but this sort of de-dollarization trend. Now, I do still think that the dollar is going to remain this world reserve currency status for some time to come, but I think that the timeline has shortened because of some of the things that Trump is doing to antagonize trade partners, but also because of what the Biden administration and EU did during the Russia-Ukraine situation by using the dollar as a weapon. And so central banks around the world are saying, well, gee, we could buy US Treasury paper, we could get some yield. But on the other side of it, we know that paper is going to be worth less because the dollar is depreciating. And we're also getting more concerned that at any moment, those assets could be forfeited because we might do something that pisses off the US. And so I think there's a compelling case to be made that gold is taking on a sort of, tertiary reserve status. Like you could argue maybe the euro is becoming more secondary. Over time, it's become more used in trade. I wouldn't say it's ever going to necessarily become a world reserve currency, but I think gold is becoming much more appealing as that sort of tertiary reserve because it's going to maintain its purchasing power. And if you're storing it either in your country or with a country or institution you otherwise trust, you're always going to have access to it, regardless of whether you piss off the United States or Europe. And that's a big change because it used to be there was this implicit trust. A lot of global central banks would let the New York Fed even hold their gold. There are all these leasing programs, but we've seen over the last decade that's going the other way. Countries want their gold back. They're buying more gold. We're seeing record central bank gold buying. We're seeing Chinese and American and Indian and other investors buying much more gold than they used to. I think this is a trend that is embedded structurally now, and I'm not going to be surprised at all if we see gold hitting $4,000 an ounce as early as the end of this year. I also think we're set up for a pretty strong silver bull market. I've been talking about gold and silver a lot over the last 3 years, and gold has been the leadership play. So gold's been where I've been wanting to be trading. It's had this big Bollinger Band breakout since early 2024. We've been tracking that, trading it, benefiting from it, and some of the miners. But now silver is set, I think, to take the reins as the outperformer. And we typically see this in bull markets that are starting to get a bit more mature, that silver starts outperforming, that we see some of the mining plays really start to show some leverage based to the underlying price of gold and silver. And I think we're at that point. So I also won't be terribly surprised, especially if China finally starts to do some of the stimulus of their domestic consumers and their infrastructure that they've been talking about, that silver could get back to some of those all-time highs, possibly as early as later this year, but more than likely next year.
So you think it's still early on then for this gold and silver bull market because only some of the miners have really started to outperform enormously. Now, a good amount of them have rallied. The juniors are starting to get some funding for drill programs. We're not really at that point in the bull market, though, where a lot of the juniors can go raise funds and build a mine. So I don't see a lot of supply coming online for gold, silver, copper. You mentioned like the difficulty for bringing copper mine online. I mean, for some countries, it could take way over a decade to bring a copper mine online. So I don't think we're going to see a flood of supply for a lot of these metals anytime soon.
I think one of your guests, Rick Rule, likes to say that the cure for high prices is high prices. And because that creates supply, that starts to tell you when prices are getting high. And you hit it on the head. We're not really seeing that supply coming online in aggregates that would concern me in gold. So I'd say gold is sort of intermediate stage. It's had a longer, more robust gold market, than what we've seen comparatively in things like silver. So I think gold, it's healthy that it's consolidating. It is up about 25% or so, or more than that year to date. I like how it's trading. I track gold based on Bollinger Band squeeze breakouts for swing trades. It's still very much in these expanding Bollinger Bands. And what that means is momentum is still strong. You still have this increased realized volatility trend, which is what you want to see over weekly. So if you take a weekly chart, You put a 50 period Bollinger Band on it with a 2.1 standard deviation line. What you're looking for is squeezes when the bands are coming together and expansion phases when they're coming apart and you're having that big directional move. And expansion doesn't necessarily mean it's going up. So you're using that 50 period average, in this case, the 50-week moving average in the center of the bands as your trend identifier. So as long as gold's trading above that and ideally hugging that top band, if not outperforming it, you're in a gold Bollinger Band squeeze to breakout play. We're still very much there in gold. We're still very much there in Bitcoin. Silver is starting to get much more excited. I think silver's an early stage bull. I think it can run a lot harder in terms of the total gains that can be put in from here in silver versus gold, especially, again, if China comes online. They're the second biggest consumer of silver in the world next to the United States. And another area that I'll drop for your audience is Palladium. Very excited about Palladium. Zoom it out on a monthly chart. It's making this huge base. Zoom it in on a weekly or daily. You can see it's really breaking out from that reversal. And I think it can catch up to its bigger brother Platinum here, which could eventually put a two handle on Palladium again.
And Platinum and Palladium were in a bear market for, I don't know, 3 or 4 years, a very, very long time. I mean, they were below the production cost. I was seeing tons of article headlines that a lot of the miners in South Africa were close to bankruptcy. It was dire. Because a lot of the demand for platinum and palladium was just the catalytic converters, but it got to a point there where all the supply was coming offline. So the market was going to have to correct and adjust there to the lack of supply that was going to be available soon because a lot of the producers were going to go bankrupt.
Exactly. And Rick Rule also likes to say the cure for low prices is low prices because it has the exact impact you're talking about. Eventually, that excess supply is cleaned up. And this is why free markets can work because they're self correcting. If the government isn't interfering with the market too much, it will often set its own prices, provided there's competition and there's fairness and there's some level of regulatory oversight. But if there isn't price fixing, if we have price discovery, high prices cure high prices with supply, and the growth of it and low prices fix the themselves with that inhibition of supply creation. And that's what it's all about. And I think that if we look at commodities from that simple view, they are some of the best momentum trading vehicles because of that.
I have the GDX, a chart of the gold miners ETF, the VanEck gold miners ETF with the senior ones and the mid tier ones up, and I mean it's still substantially off the all time high in 2011. So even though the gold price is retreated a little bit, I think it's a little right around 3,300 or a little bit below that right now when we're recording this interview. I mean the gold miners ETF. The companies have rallied, but it's still substantially off a good 25-30% off the all time highs back in 2011.
Yeah, and I have a certain junior miner I'm a fan of. It's Rio, and I own this one. So full disclosure, it's a long-term investment for me. It's already been about a 10 bagger for me, but I think it has a lot more to go. And it's Rio 2. It's run by Alex Black. He's an Australian. He's out there, I believe, in Chile running this mining company, and they are very early stage. Their Phoenix mine should be getting online next year. And gold has appreciated to levels that are far higher than what anyone was really looking at when they modeled this thing. And energy prices are still reasonable here. Energy is one of the biggest costs for these gold miners. So that's one that if it pulls back, and you have like a little bit of volatility, it could be worth looking into. Get to know the business, look at it, see if it fits one's risk parameters. It's obviously not financial advice, but this is one where I think they have a lot of future potential. So if you're more looking for that speculative play in gold, where there's the bigger risk, but also potentially the bigger reward, that's one of the places that I really like right now.
We might see that one get taken out. I mean, there's going to be mergers and acquisitions starting to pick up. Sandstorm Gold was just taken out. I mean, I thought it was a discount. I know a lot of Sandstorm Gold shareholders aren't really happy with the price that was paid, but Royal Gold now, the combined company, is going to be arguably one of the top ones in a couple of years, maybe by the early 2030s if things play out, because they're going to be they didn't have growth. So they had like this high valuation. They had a lot of cash flow right now, but they just didn't have any growth. Now they have a ton of growth in the pipeline and a lot of diversification coming online.
Yeah, I just looked at that takeout as you mentioned it. I agree it was cheap. They got a good deal. It's good for Royal Gold, and I could understand why Sandstorm shareholders wouldn't be particularly happy with it. I'm one of those shareholders. It's not a big position for me, but on the other side of it, I'd say this is kind of one of the risks in the space that sometimes these things don't necessarily deliver the kind of performance or the acquisition prices you'd hope for, just because it's really one of the more hated parts of the market. It's still very underallocated, even with how much gold has performed, especially in the US and even in Europe. People don't want to own it as much in the institutional space or its producers
Well,
or
I've
its
been co-
royalty companies.
I've been covering oil and natural gas stocks and mining stocks since like 2008, 2009. A lot of the times these small caps, the ones with good growth cross prospects, just as things are about to turn and the company's about to start making a lot of money, you have a larger company come in and they've already talked with what the institutional investors, the large owners of the small cap stock, they've already negotiated with management team, and then they get a buyout done. And so like it's happened so many times I've lost count with a lot of these smaller resource companies.
Yeah, and that this was what happened with the first Rio mine, although it actually was at a pretty appreciably good gain for investors compared to what happened with Sandstorm. I mean, that's my exit strategy on the stock. I do fully expect that it's going to be a buyout just at multiples higher than what it's trading at now.
So I want to ask you about investing into like these data centers because I hear this all the time from institutional investors, people like your business partner Aisha Tariq on Fox Business. They always ask her like how to invest into artificial intelligence and the data centers. Do you think that natural gas and uranium nuclear power are some of the best ways, or do you think there's other better long-term ways to invest in data centers and the ramp up?
I think that the power plays have appreciated such that they're not quite as attractive as they were before. I think right now there's more talk of fusion, nuclear fusion. Google is investing a lot in that. You're seeing some of the lithium plays start to take out, so may or take off, I should say. So ALB. Albemarle, that might be one to watch here. It's had a pretty powerful move recently. It looks like it's making a base that it can break out of on the weekly chart. We've been tracking this one. I was just on Benzinga Live this morning. This was one of the short squeezes that we were also trading because of that breakout. But I think this thing, if we can see it break above the 50-week moving average, this could be a swing trade or investment to really look at as a part of that pivot. The other area I would look for is, why don't we look at the data centers if we're excited about data centers? So EQIX, Equinix, if you zoom this one out to a monthly chart, first thing that I would note is during COVID, that monthly candle just has a wick. It recovered so quickly from the COVID crash, you could have blinked and missed it. That's a very good sign for any company where it's able to be so resilient under a period of time of such intense financial stress. Recently, it's seen a pretty big markdown. It's down about, 24% from its all-time highs. And this has everything to do with margin compression from increased capital expenses on building out data centers. They're increasing the amount of data centers. They're specializing more for AI and for more bandwidth intensive applications. This is the kind of dip that I personally like to buy. I know my friend Jim Chanos is not a big fan of this company. He's been more on the short side, but I think that part's played out. This has been in my forever portfolio for over a decade, and I think there's still more room higher here if we consider that we're still early on in the global expansion of data centers. Could Capex slow? Yes, I still think that's a tail risk. We talked about that the last time I was on here. I still think that's a tail risk with the efficiency race that's underway with AI, but I don't think that it's something that's going to necessarily stop the momentum. It just might slow it a bit. And with a company like Equinix, as we see the world interconnecting more and more with higher speed internet, as being a business involves moving more and more data around, and is just in general, the scale of storage and interconnectivity grows. This is one of the direct beneficiaries that I would continue to keep an eye on. Another one would be Corning or GLW. Now, Corning has had a great run, so I wouldn't be buying it here. But on any huge pullback, like what we had happen, for example, during April with all the chaos from Liberation Day or hour or however long it lasted, that was enough to bring this thing down appreciably. That was a very buyable dip in something that is in a secular bull market that's going to be another thing that maybe one wants to have in that 5 or 10 year portfolio on appreciable pullbacks. And then Freeport McMoran, I like this company a lot already because of the copper supply and production deficit. So we were already looking at this as a swing trade and as an investment in like the three handles of its trading. But with what's happening with that copper tariff, that's bullish for Freeport because they do have a lot of activity in this country. So that could be margin expansion for them. And then on the other side of it, if you're wiring up a lot of data centers, it isn't just fiber, it isn't just real estate or data center REITs like Equinix, it's also copper. Copper is still very much a part of that whole play. And so I think that, where we're looking for opportunity is going to be some of the places that are a little more either, I would say, overlooked or structurally embedded for long-term growth. And then energy as a whole, not just natural gas and uranium, but the whole XOP and XLE. I like these for just the overall trend of we're likely going to be using more energy as time goes on. OPEC Plus's ceiling of supply, the increases they've made are very nominal. They're not likely to be realized. And we have a world that, sans the episodic recessions that we may have in the future, is likely to become more hungry for more energy, particularly as we see all these new energy intensive applications scaling, not the least of which are data centers. So I still like XOP and XLE as considerations for investment here. They're probably the cheapest part of the S&P as well.
Well, natural gas is down substantially in the last couple of months. Isn't down about 20%, the U.S. natural gas price. But then all I see in the headlines, Mayhem, are that the United Arab Emirates, they're announcing a deal with OpenAI for their own Stargate data center, that they're going to start construction because they say, oh, we have cheap natural gas. Why not build our own data center? So we have computing. We can have a tech sector in Dubai or the United Arab Emirates. Russia's even talking about the data centers because they obviously have the energy, the natural gas, so they don't have to go import the natural gas. They already have it. So, I mean, if they have the domestic supply of relatively cheap natural gas, they just have to build a pipeline from where they produce it to the data center then.
Yeah, absolutely. And most of the power in the United States is also driven by natural gas, and it's a pretty cheap source of power, even though, natural gas can be pretty volatile. It's often called by traders the widowmaker, appropriately so. I think that overall, structurally, we're going to see the companies that are involved in this space have more and more opportunities, both abroad and here at home.
And I don't see the data center capex go to zero. In fact, it looks like a lot of these other countries, they're behind the curve. So like
Yes.
United Kingdom, European Union, I think just announced a 200 billion that they announced that they're behind the curve, that they're going to start committing 200 billion in capex because they don't want to have to go to the United States or China and say we need to borrow your computing power for our artificial intelligence software. They want their own data centers and their own computing power.
And they kind of have to, because when you look at how these things can be used, if you're, for the kinds of applications that AI may be used for by governments and corporations, you don't necessarily want to have all that data in someone else's cloud or someone else's, data center. And so I can see why this becomes something where there's a fair degree of nationalism potentially coming into play, and justifiably so. It is a legitimate national security concern.
Yes, especially with potentially like quantum computing advancing, what that could break a lot of the encryption. I mean, I'm not sure I even want to think about that. That's kind of like worst case scenario.
Well, I'll say with that there is a silver lining. And so when you look at what's happening with encryption and really the research to get ahead of this, you're already seeing a lot of companies, governments, otherwise adopting what are thought to be quantum resilient algorithms. These are algorithms that are specifically designed to be more difficult to crack using sophisticated quantum computing. And while we've seen advancements in, cracking very simple RSA encryption with quantum, that tells us that as it scales, it's very likely to crack RSA. RSA is decades old. We can get something much better. And so these new quantum resistant algorithms, I think Kyber is one of them. I've even been able to adopt them on my own digital infrastructure without much issue. So the pain that is often involved with transitioning things on a technical side is very minimal here. There's a lot of support in the commercial and open source libraries. So really the only area, and maybe this will be amusing, I don't know, but the only area we're not seeing that big movement in is crypto.
As we wrap up here, I want to ask you maybe which sectors or industries you think over the next couple of years could potentially outperform the general stock market indexes.
So that's a great question. I think when we're zooming out a bit here, there is a lot more uncertainty now than what we're used to. Like, there used to be a little bit more forward visibility, I think, because we didn't have such unpredictable policy outcomes. But if we take that out of play, I'm still very constructive on energy. I'm still very constructive, especially on the smaller companies that are getting involved with AI, and they might be able to turn this into a profit engine with a lot more opportunity to scale. So I still think the scrappier growth AI startups that are realizing lower and lower costs and easier opportunities to scale, there's still a lot of opportunity there. That's going to be probably a multi-year, if not multi-decade opportunity. I also continue to, it's not something you want to be bullish of, but I'm still bullish of defense stocks. And I've had things like Northrop Grumman, you mentioned off mic earlier, SAIC. I mean, a lot of these companies I've had as long-term holdings, because if one thing we see as a constant almost every year is the defense budget continues to balloon, and these things outperform the S&P. So that's another thing that I still think is going to be a continuing trend. I don't think we really get away from that. In fact, I think now the opportunity is probably in European defense contractors and some of the other international defense contractors, as mandatory NATO spending is going to be reaching like 5% of GDP for a lot of these countries. And I continue to be bullish of companies that are in the digital entertainment space, because I think AI is going to have a big disruptive effect there. I'm really bullish of Nintendo, for example. I've been very long that thing for over 2 years. It's been a big performer, more than doubled on the Switch 2 release, has been very well received. But we're seeing video game companies like Nintendo, who don't just develop their console, they also make a fair amount of the games for it, starting to eyeball AI pretty aggressively as well. And I quite frankly think that it would be a perfect fit for them to bring down their operational costs. And then I'm still structurally bullish on gold and silver and copper and really all the things that we have that need to make the world possible in its real form. I'm still quite bullish on energy as well. And I think that we're going to have a market where some of the older economy stocks can outperform. Now, in the much nearer term, as we get into the next year or so of trading, so like let's say getting into mid 2026, I'm also looking at places like consumer staples. And the reason is I think we're in the early stages of an M&A cycle. We could see it with what's happening with Kellogg. Then on the other side of it, I think that we have a lot of companies that pay dividends that are underappreciated or misunderstood or neglected. And that tends to be the beneficiary of a Fed cutting cycle, which I think will inevitably start at some point later this year. I do think we'll get a cut or two. And if we do, those dividend stocks also become more attractive. And one of the ones that I like as a swing trade right now, using the 50-day moving average to guard risk, is Tootsie Roll from here to about 40 to 42, TR.
The candy companies, that's interesting given the amount of diabetes and stuff like that. I know there was a consolidation over the last 5 or 6 years. A lot of them were bought. There was a huge merger and acquisition with the junk food and candy and snack companies over the last like 5 or 6 years. A lot of them were bought.
Absolutely. And I think that we still have another cycle of M&A to go, more in the packaged food space. So not necessarily in the candy companies, but, cereals and juices and other kinds of staples that people are buying. But the candy company specifically that I like here is Tootsie Roll, because it's got a great trend structure. It looks like it's part of a much longer term breakout that's happening. And it takes us back to a price range of about 40, 42, where I'd want to probably realize those gains. And yes, this one could be another buyout target, but for me, it's more of just a trade. The other stuff I talked about a little more earlier, those are more secular plays. So I think that at the end of the day, we have to kind of appreciate that we're in a period of transition. The digital transformation is something that's going to be a long-term secular theme. The sort of fourth industrial revolution that we're in, where technology is increasingly becoming a foundational part of every industry. And if you don't adopt it, you get disrupted by it. I think that's an ongoing play as well that we have to be cognizant of. And I'll also go on to say, just to add to some of those earlier themes, automation, robotics, cybersecurity, we have to be involved in these spaces as well. Automation is going to become a much bigger deal in white collar work, but also in blue collar work, and using robotics in factories, and for, the ability to be able to do deliveries and other things like that. That is going to scale in time. And eventually someone's going to get full self-driving, right? My money is on something like Waymo that combines vision and LiDAR to be able to do. And I think where it will really be profitable is transit, moving things across the ocean, moving things across roads, being able to deliver to the last mile. I think that's where it's going to scale the most. And eventually it's going to become more used for commuting, moving people around. But I think that there's a lot of opportunity in that space that's going to be very interesting, and how robotics and automation change how we interact with the world and how companies move products around the world and build products in factories. And then when we're looking at cybersecurity, the amount of attacks and incidents that have been happening, the compliance requirements that are ratcheting up, not just here, but globally, it really behooves just about everyone, whether you're a business or a government or even a household, to take this stuff more seriously. So that spend is something that I continue to see as more utility-like than cyclical. You're basically, as long as you have a business and you want some degree of being able to say you're going to have a business tomorrow, next week, next year, you're going to have to be investing in cybersecurity, because the kind of attacks that are coming on right now will kill, or at least very significantly injure, businesses that do not handle these large scale outages and ransomware attacks and exfiltration of data more elegantly. Obviously, the death risk of a business is much more in the small to medium sized businesses, but even in the large ones, it can be highly disruptive. Like MGM, I think a year or two ago, had a ransomware attack that put them out for the better part of a week. That things like that are not easily recovered from. So are these supply chain attacks, like what happened with SolarWinds. And we're seeing the Chinese government doing more and more of those types of attacks, including attacking our telecom infrastructure, and so thoroughly becoming embedded in it that we can't even say whether we've got them out yet, whether we even know. So I think that cybersecurity has a lot of confluence with AI. We're seeing more and more AI automation to be able to look at large sets of data, to be able to analyze whether there's attacks, to look at code, to analyze whether there's an attack surface, to be able to do things like penetration testing that used to take a team of engineers. Now a single agent can do it in a much smaller period of time. That's all really constructive for the space, but it also tells us that we're getting closer to a point where the good guys can at least keep pace with the bad guys. So I'd say there's all kinds of secular trends to be excited about. And the biggest thing that we need to do as investors with markets at all-time or near all-time highs is make our shopping lists, be very diligent about how we accumulate, and be very patient. Investing is a journey. We're looking for long-term returns to build wealth, and we shouldn't try to fast track that process by getting FOMO, getting ahead of ourselves, and potentially getting hurt. So pace oneself, dollar cost average in those favorite names you research and you like, and always keep an open mind.
And you mentioned Waymo. So Waymo is owned by Google, right? They haven't spun it
Yes.
off.
Yes.
Okay, so that's potentially, so Google's going to be losing a lot of their profits from general search, but Google seems to be adapting with Waymo and VEO3 and some of their artificial intelligence software investments. So it's looking like they're starting to come up with an adaptation plan.
And Jason, another thing about Google that's very exciting is their TPUs, because they've been able to create hardware that they can use to train models and infer the data sets on those models, which means that they can, in their ecosystem, replace a lot of what NVIDIA is doing. And there have been more rumors that companies like OpenAI, which are using AMD chips as well as NVIDIA, may start to look at Google's TPUs. They've officially denied that for now. But before that, and maybe days earlier, there was a story run by Reuters that was saying, there may be some adoption of these chips by OpenAI. And I think that if you look at Google's cloud, this is another area of opportunity, because what are they doing with their TPUs outside of using it for their own models? They're renting them out. So I think there's a lot more upside that's not really priced into Google here than people realize. Yes, they've got the regulatory risk, they've got the search risk, they've got the risk that maybe Chrome gets split out from under them. But at the end of the day, this is a company that you can pretty much put in your portfolio forever and forget about it.
Now, you mentioned increasing spending with the European Union because Trump wants NATO. They want them to, 5% of GDP for NATO. And also the U.S. defense spending is in the big, beautiful bill for upgrades there. We just saw an announcement. There's a video today by Pete Hegseth, U.S. Secretary of Defense. And he's talking about basically deregulating drones and spending a lot of money upgrading our drone technology. Do you think then that the drone industry is going to heavily benefit from a lot of this spending then?
100%. And I think everything that feeds into it as well. So companies that have AI that can help to automate these drones, that can help to, provide some degree of analysis of targets and being able to identify and engage in strikes and otherwise, pretty much for national security reasons, we have no choice but to expand our fleet of autonomous defensive and offensive capabilities. And drones are going to take the lead there. And so this is one of those policies where I think it's kind of a no-brainer to get involved in the space if one isn't already. But also, it makes a lot of sense for this to be a more secular tailwind because at the end of the day, when you start to see where war is going long term, if you aren't able to be a leader in drones and robotics and AI and automation and otherwise, you're going to cede a national security advantage. And the United States is going to be competing with China on this front. And China is the biggest maker of drones in the world. So there's a big hill to climb here. But I think if any country in the world can do it, it is the United States.
Is there like a drone exchange traded fund or any specific companies?
So I don't know of a drone exchange traded fund right now, but I do think you'll start to see some of that come out. When I was on the Benzinga call earlier, we were looking at some drone names. I don't have them in front of me right now, but I would say that that's a space where you can do some research, find maybe a half dozen or dozen names, and then start to screen their fundamentals, look at the kind of agreements that they're getting. Another thing that I would also say is look at things like what's happening in the rare earth space. The Defense Department just became the biggest investor in MP materials to get access to those rare earth metals. So that's also going to be something that we really have to take a close look at because there's all these trends underway that have everything to do with how policy is morphing right now. And I guess two others I'll share with your audience that we've been thinking about. One of them is accelerated permitting and how that could be a catalyst for some of the oil, gas, mining industries over time. And another one is some of the deregulation efforts that are happening. So, at the end of the day, these are things that are tending to be business positive. So, like you said, as we started this conversation, yes, there's a growing set of dark clouds on the macro front to be concerned about in some places. But in other parts of the macro, when you see deregulation, where you see large scale public investment, where you see these trends that are taking shape in technology, it's hard not to be excited about where that ultimately heads.
Yeah, I don't think we have any control over the automation at this point because people who watch the Trump military parade, I mean, there was automated tanks. They were smaller than the normal conventional tanks, but they were basically remote controlled tanks. They were automated, and there was a 60 Minutes mini documentary on Palmer Luckey. You know who he is, the
Yeah.
Oculus Rift guy with the headset. I mean, he's working on a fully automated fighter jet he's testing right now.
And that's exactly, love it or hate it, that is where the future of warfare is heading. It's going to be, as a result, a lot more asymmetrical because there'll be less capacity for human loss on the side that has all of these autonomous capabilities, offensive and defensive. But on the other side, that's exactly why, if you're not there, you're at risk because then your opponent has that asymmetrical advantage. So it kind of sets off a global arms race in autonomous defensive and offensive capabilities. And it also, not just in the kinetic space, it's also in offensive cyber attack capabilities because part of what governments are going to be doing in the future, increasingly, they've been doing this for some years, but increasingly, wars are also going to be fought by crippling infrastructure using sophisticated attacks, by exfiltrating intelligence that lets you know exactly where your targets are, et cetera, et cetera. So there's all kinds of fronts in this space that, again, keeps me bullish on a lot of the defense as a whole. But it was also one of the reasons I was an early investor in a company like Palantir. My cost basis in that is $7. It's been about a 20 bagger. And yes, it's extraordinarily expensive here. And no, I would not encourage people to buy shares right now. But I'm not selling the shares. I'm just selling calls into times where skew is blown out towards call premium to reduce my cost basis. And then if I have shares called away, I'll sell puts until they get put back into my portfolio. But I think that's one of many companies that are big disruptors in AI, defense, and this sort of digital transformation front that we need to identify as investors to have those sort of outsized returns. So I think that there are a lot of things to continue to be excited about. We just need to be patient and remain studious, keep our minds open, always look for new opportunities. There's always an opportunity somewhere.
Especially for this tech cycle, Mayhem, it sounds like there's going to be a lot of capital expenditure required that's instead of the past that was just software upgrades, it's going to be a lot more infrastructure upgrades, materials upgrades. So the natural resources, the commodities investors are also going to benefit from the increased usage of energy, metals, rare earths, natural gas, nuclear power, the key strategic metals, copper, those types of maybe some silver or platinum and palladium, those types of other things as well. Because this tech cycle upgrade, it doesn't sound like it's just software this time.
It's definitely full stack hardware, software, applications, and then the talent involved to harness that potential. And again, we're talking about job losses in some places, but there's still going to be humans involved with a lot of this. There's going to be job creation in a whole host of other areas. So, I would not take the just the one-sided pessimistic view. I'd be very nuanced in it and say, yes, you're going to have creative destruction. Yes, there's going to be job loss, but there's also going to be some of the greatest opportunities we've ever seen at the same time.
Oh yeah, I agree. Especially if you're a small business owner and you can adapt to this artificial intelligence software and use it, you can cut your overhead. You can improve your marketing on YouTube or podcasts. You can maybe even do a TV commercial cheaply. There's a lot of opportunity there for someone who adapts to this new technology in another industry.
100%, 100%.
Well, I've kept you for over 90 minutes. I think we could keep going for a lot longer, excuse me. But I'm getting kind of tired here. I want to thank you so much for your time. My listeners want to check out Macrovisor or Trader Aid. How do they do so?
Yeah, absolutely. We'd love for you, everyone, to come check out what we're up to. You can visit us at macrovisor.com and traderaid.com to see what we're up to. And then, check out my Twitter feed at Mayhem 4 Markets. That's Mayhem number 4 Markets. YouTube, same channel, Mayhem 4 Markets. And, just check in, see what we're up to. And if you like what you see, come on by. We'd love to check you out. And then also to everyone out there that followed me to Jason's podcast here, like and subscribe. He's got so many great guests. He's an excellent host. He's absolutely brilliant. If you aren't already subscribed to your YouTube, you're doing yourself a disservice. Do everyone a favor, subscribe to Wall Street for Main Street.
Yeah, I should hire you as a hype man now. You could be my hype man. You could be my opening act. Maybe we should do a weekly show. No, a bi-monthly show. Maybe you and me should do a bi-monthly show then.
I'd be happy to look at doing a show with you. We could increase the cadence of these talks and do something more regularly.